This is a quick video to explain just how significant interest rates are to the overall profile of your mortgage. Here I am showing a 25-year mortgage where we are always borrowing $250k overall. I'm quoting the payment amount in months as this is a more familiar, relatable number to you, but the charts are in years, so £946 times 12 months is £11,352. You can see this is the sum of these two numbers, and we pay this same 11.3k annually until we have paid off the loan in full. On the right, I am showing in grey the percentage of each annual payment that goes towards paying interest, and the amount that is paying down the loan principal, i.e. the original 250k, in yellow. You can already see that you pay more in interest in your earlier payments than in your later ones. Separately, on the left, I am showing how the payments build up over the 25 years. How, at this 1% rate of interest, you could pay back 250 grand and pay a total of 34k in interest in the process. So to get to 250k up front, it costs you 284k over the life of the mortgage. So let's play this through, increasing the interest rate all the way up to 11%. As you can see, it's pretty brutal. For borrowing this exact same 250k over the same time period, you pay an additional 492k in total and 742k overall. Crucially, as you can see, almost the entirety of your early payments is going towards paying interest rather than towards paying down any of the loan principal. After 10 years, you've paid a total of almost 300k, 50k more than the 250k you borrowed. But you've only actually paid down 36k of what you borrowed. The rest has been lost to interest payments totaling 260k. This is a bit of an extreme, so let's put it into a more realistic context. You can see from this Bank of England data that 2% is a fair reflection of average mortgage rates over the last 10 years. So if you borrowed 250k 10 years ago at 2%, you've paid off 85k of principal with exactly 2/3 of your payments to date going towards this. You've paid 42k in interest, so 128k overall. Let's say you had a 50k deposit too, so could then buy a house at 300,000. Since it's too abstract to talk in terms of just percentage increases here, I'm going to roll the historic house price change data forward. The 300k house you bought 10 years ago is now worth 513,000. So you're in a great position. Your house is worth £500,000 and you've made significant progress in paying down your loan principal. Let's contrast this with a 7.5% borrowing cost today. If you borrow 250k today at this rate, how does your position look in 10 years' time? By this point, you've actually in total paid almost twice the cumulative amount than the borrower who managed to secure a 2% rate. But despite paying so much more in total, you've actually only paid off 52k of the principal, 33,000 less than the 2% borrower had paid off by this stage. Instead, a whole 172,000 of your payments has gone towards interest. So the straightforward fact is that increased borrowing costs increase our monthly payments. That is self-evident. But it's also about how badly these higher rates prevent us paying down what we've actually borrowed. Fine, it's still 25 years in total, but paying down so little in the early stages screws us enormously into paying vast amounts more overall, and also leaves us more sensitive to any further rate rises in the future, since the interest is charged on what principal we have not paid down.